Susan Wilklow is the president of the Wilklow and Associates, CPA. She received her bachelor's degree in accounting from Indiana University in Pennsylvania before moving to Colorado. And in '89, she became a certified public accountant in Colorado. In 1996, Susan graduated from University of Denver with her master in business administration, graduating in magna cum laude. And Susan's experience has come from working with Fortune 500 companies, as well as privately held companies. In addition to her audit experience from her first job, she went on to work with Lincoln National, GTE, and Ford. In 2003, Susan launched her private practice, Wilklow of Associates, P.C. During the last 10 years, her business has continued to grow to include opening a second location, and now located in both Colorado Springs and Trinidad. Services individuals as well as businesses. In the past year, the firm has been recognized as the best of Springs, as well as one of the fastest growing firms in Colorado Springs. And Susan was the past president of the National Charity League, Colorado Springs chapter, and currently sits on the board of Youth for Christ. She is actively involved, volunteering with her church and other nonprofits. She has a wonderful and supportive husband, Stephen, and two daughters, Delaney and Morgan. And she loves tennis and golf and her pets. Welcome, Susan. Thank you.
Well, thank you all for having me. One thing I forgot to mention, and it wasn't part of that bio, is that I too have been where you are. I have real estate holdings. I have had fix and flips, with buy and hold. There's been a large area within the real estate market that I've actually touched. And that is how I got started with specializing in real estate in my accounting practice. So today, I hope to, tonight, keep your attention. I know you all are experiencing some margaritas, so I want to keep everybody awake and active. And my slideshow wants to keep going to the next slide, which is amazing real estate facts to entertain your brain. So I want to keep everybody engaged here. And so we're going to just go through those because I found some really interesting facts. And some of you may know this one already about McDonald's holdings in real estate really make up a large portion of their financial portfolio. And the corporation itself owns that real estate, and that is part of why they are so valuable as a corporation. Warren Buffett is one of the richest men in the world, and he still lives in the same house that he bought in 1958. He paid $31,500, but if you think about it, in 1958, that was a lot of money, and it looks like a really nice house. This was an interesting fact for you who that are landlords or you're doing fix and flips. We're always trying to get rid of those brass doorknobs because they look old, and you know, if you're doing a nicer home, you want to upgrade everything. But I had no idea that they acted as a disinfectant. And so the metals themselves actually kill bacteria. So I thought that was a really interesting fact. Did any of you know that? Who would have thunk? I did read this story because after I saw this, I thought, okay, I've got to really check this out and see if there really is a guy who traded a paperclip to end up with a house at the end of the day. Now, I can't say it was much of a house, but along his way of trading and over a course of time, he constantly was able to upgrade and eventually ended up with some real estate holdings. So you never know. I really like this fact. So in Scotland, homeowners paint their doors red when they pay off their mortgage. Isn't that nice? You can tell who owns their house and who doesn't. And this next one is pretty fun too. Charles Pretty Boy Floyd, who was a gangster, was loved by the public because he destroyed mortgage records, and back in his day, the only way the records were kept were paper. So if they were destroyed, they couldn't figure out what was owed. So everybody loved Charles. Wish we could do that today. This is another one I did look into because I found it interesting that Monopoly was put together for trying to show that capitalism didn't work. So I think we know that didn't work out very well for the makers of that game. And this was a really interesting one too. India's richest person had built a home that was over $1 billion and 27 floors. Isn't that amazing? And some of you, if you're from New York, maybe you know this. If you sell a house in New York and you believe that it's haunted by ghosts, you have to disclose that fact. Now this one was a little scary to me, that a 30-story skyscraper could be put together in as little as 15 days. I'm not sure I'd want to go up in that skyscraper personally, but I guess you can do anything if you use prefab and, you know, slap it together quickly. So those were my fun facts. So before we move on to the tax deductions that you may be missing, and that's the topic for tonight, is tax deductions that you may be missing. I'm going to gear it more towards the buy and hold market, but the concepts work for fix and flip or businesses in general, but my focus is going to be on that. So out of everyone here, how many of you own a buy and hold real estate? How many of you have a rental property? Okay, good, good. So hopefully you'll hear something tonight that you'll be able to use in your upcoming tax season. So every year I get the opportunities to look at other people's tax returns, and I'll call it do-it-yourselfers. And you want to save some money, you want to do it yourself, hey, how hard can it be? And what I find a lot of times are just some basic missing deductions that you don't think about. So we're going to try and hit those tonight. So as far as deductions, one of the basic deductions for real estate, whether it's a buy and hold or fix and flip, is going to be interest. And so most of you understand that your mortgage interest is something that you can deduct, and you know that you get a 1098 and it's reported to the federal government, and you use that form in which to take the deduction. But I want to make sure that you're not missing some of the other deductions that are available to you. So if you used your credit cards for purposes of buying goods or services that were used in the course of either your rental or your business, that interest is deductible. If you had a personal loan from somebody who provided some funds for you to be able to either buy or do some improvements, that's deductible. And then, of course, if you used some people, when they get started and they buy a house, they need to do some improvements for the rental, they'll take out a HELOC, and that interest is deductible. And I would apply that interest against your rental property as opposed to trying to put it against your personal residence. Employees and independent contractors. How many of you here have employees with your real estate activity? Anybody?
Fine.
Okay, okay. So you know you have to file quarterly reports and those W-2s, but I bet almost everybody in this room, now I'm going to ask the question, how many of you have used a contractor to do services for you? Okay, so most of the hands have gone up. And those are the people that we have to make sure, as we get to the end of the year, that we have obtained a W-9. If you don't know what that is, go out to the irs.gov and type in W-9 in their search bar, and it'll pull up the form. It's actually 4 pages, but really you're only concerned with page 1. And that page is what you provide to whoever has provided you service, and you say, please fill this out for me so that I can issue you a 1099. And they may say, what? I'm not going to do that. You've already paid me. I don't care. So my advice to you as you go into your next year, if you have that experience, is to ask for those up front before you write that check. It's easy to get things before people are paid. It's hard to get them after. So get that form up front. And then if they do provide services to you that exceed $600 in value, more than likely you're going to issue a 1099. And just a reminder, last year the rules changed as far as the filing deadlines. We still have to get those forms out to the individuals by the end of January, but last year, the big change, well, it's actually still this year, 16, but the change was that as a reporter, as the person who is the payor, you too have to have those forms filed with the IRS by the end of January. So it's really important that you take the time now to get those items in order because January just flies by. Insurance. If there's one expense that I see that's missed more than any other, it's insurance. And why is that? A lot of times when you have a rental property, your insurance is being escrowed by the mortgage company, and they take it out, and a lot of them don't explicitly show that amount on the 1098. Some do, some are really great. I love those companies. Some don't. Wells Fargo, one of them that just doesn't explicitly state it. Now, so how would you get that information? There's several ways. Number one, every one of those mortgage companies provides you with an escrow summary somewhere throughout the year. It might not be at the end of the year, it might be mid-year, and typically that's when it is. And you know, if you just stick that document with your tax documents, you'll find that that information you need, because that insurance is paid once a year, it's right there. And you can take and add that information to your tax return. Another way to get it is, of course, we could always just go online to the mortgage company and that information will be explicitly stated. And finally, if you ask the insurance company, if you remember who it is, sometimes I've had people who forget who was carrying their insurance. It's been with the same carrier for so long, they don't see the bill, it just gets renewed, and so they forget who it is. But if you remember, you can always ask them as well as far as what you paid in the last year for your insurance. So don't forget to take advantage of the insurance expense. And as probably most of you know, we live in an area where we have a lot of hail. In the last couple of years, the policies have really gone up in terms of what you are paying, whether you know that or not. They've gone up quite a bit. So it's really a big expense to miss out on. So make sure that you take advantage of that. Travel. Do any of you travel to your rental properties? Well, if you don't, you should be, because you need to go around every once in a while to make sure those people are still taking care of the lawn and everything else that is going on with the house. And so it is good to do a few drive-bys, for those people who pay you regularly and they're great with payment, drive by. It's deductible. So make sure that you track your mileage. There are a lot of great apps out there today that work with almost any phone that you have. You can just download them. You just press when you're starting out. And they create a great log for you, which is great documentation for purposes if you would get audited. So keep track of those miles. You have a choice actually whether you use actual or mile reimbursement or the standard mileage rate. For 2017, it's 53.5 cents per mile. The 2018 rates will be out next month, and they'll probably not veer too much from that number. In the last few years, we've seen the number go down because the price of gasoline has gone down. So anyway, that's a great expense item. Another one that I like to throw out there, and some of you, I talked to a few of you, and you have some holdings that are out of state. How many of you have rental houses out of state? Okay, great. So maybe you fly to go see those. Maybe you do something else on the way, but that's fine. You can still deduct the cost of your trip. Now, you might have hotel, you might have meals. So those things are all deductible. Of course, meals are limited to 50%, but anytime you're going out there to check on your property, you can deduct those expenses. How many of you have seen those landlord cruises out there advertised? So there are cruises available too. I mean, if you're running a business and you use there's a couple companies out there that offer landlord cruises, and what they do is they teach you along the way, and it's a great opportunity if you want to go somewhere more fun and be able to deduct it, those are available and they're legitimate expenses. Did you have a question?
I did. You mentioned 50% on meals. So if you're an hour away from your home, it's still 50%, or is it a full write-off?
No, it's still 50%. The IRS believes you're going to eat regardless of whether you're doing business or not. So they're only going to allow you 50%. The only time we ever get 100% deduction is if it's considered a, I'll call it a de minimis fringe, and you'll hear me say this word later, but let's say you all worked for me and I threw a Christmas party and I paid for the whole thing. That would be allowed for me to take 100%. Other than that, it's 50%.
Is there limitations on Christmas parties you can throw?
Well, we're going to talk about that too, coming up.
Call it a promotion. Marketing budget.
Well, and that's a good point that Shane brings up, is if you're doing some marketing, certainly that's a different situation. Let's say you're doing an open house and you're showing a property and you provide a platter, a sandwich platter, or you provide cookies. That's fully deductible. Or you take donuts to your friendly real estate agent. That's fully deductible. Okay? Great question. Casualty and theft losses. Now, how many of you have ever had any losses related to somebody damaging your property? Me too. Me too, and you don't want to have that happen very often. Well, the important thing here is to determine how much was the value and to make sure that you document. I have this great case, and this was from a, actually it just got settled in tax court, and it was a Florida couple. And I'm just going to kind of read through the highlights because I think it's really important to understand why these people didn't get to take the full deduction. And it covers an area that we're going to talk about too, which is documentation. So, and then checking our references. So what happened? This couple, they had a house and it had been their personal residence, and then they converted it to a rental. And so that's all good. There was nothing wrong with that situation. They advertised and they found somebody to rent. These people, their check bounced before they moved in. So, you know, the first thing would be make sure that you get certified funds if you're going to let somebody move in the same day that you're, or a money order or something like that. So you know you have good funds when somebody's moving in. So, I mean, these people from the get-go scammed this couple, and this couple was trusting. The second thing that happened is that they rented a fully furnished house. So there was furniture and draperies and different things like that. And so when they finally caught up to the couple and they went through the eviction process, they got them out of the house. But then they came in, of course, the furniture was gone. There's a shock. The furniture was all gone. And what was left was damaged. So then what they did was they were able to track down, and these people did what appeared to most of us to be all the right things, except for a few. So they went ahead, they contacted the sheriff. The sheriff said, okay, we can't decipher what's yours and what's theirs. Why don't you come up back the next day? And everybody meet the next day. Well, guess what? The people didn't come up. They left again. There's a shocker. So they never got, they did get some things back, a few things back through the course of a lot of heartache. But then to aggravate the whole situation, instead of, this happened in 2011, in 2012, they took the deduction because they wanted to wait till they knew what the loss was, and they were really trying, like I said, to do the right thing. What they didn't do was take some of the repairs and maintenance in the year that they actually did the work, which was 2011. So when this particular return got audited, the claim for about $30,000 got denied. And so they went to court, tax court, and what ended up getting allowed was $9,000 out of the 30, so 1/3 approximately. And the reason why they said that they didn't allow all the money to be deductible was, number one, the people didn't do good due diligence. What didn't they do? They didn't check the credentials, because when they found out about these people later, after the fact, they found out that this is something they did regularly. They regularly scammed. So they didn't do a background check. So for all of you who rent, I hope you are doing background checks before. Some sort of check. There are a lot of companies out there that do that. So check the references. Check their prior landlord. You know, do all the background check. And then secondly, they estimated some of the values, because some of these things were things that they had owned. So the sofas and the chairs, these were furniture pieces that came from, you know, over the course of time. So if you think you're going to turn something into a rental and you're going to fully furnish, I don't want to say keep every receipt, but I'm going to say try and keep a lot of them, because at the end of the day, had they had those receipts, they may have been able to get more dollars. And the bottom line is they got a really crappy deal, and unfortunately they just hit the wrong person and ended up not getting the what they could have, you know, what some people might have been able to get away with.
Talking about receipts, when I'm charging on my credit card, do I really need to keep all of those receipts when I got a credit card account?
Well, you know, what's nice today is a lot of the credit card companies send you an annual summary. And so I would recommend keeping those for sure. And then the other thing is documenting what the item was for. I mean, we all think we're going to remember that, you know, hey, we bought this thing from Home Depot for house on Caceres, and when really it was for the house on Austin Bluffs, and we forget. So be really diligent about documenting what the things are for.
Susan?
Yes?
If you have a personal asset that you're going to put, like furniture, into a rental, I'm guessing the best thing to do is actually sell it to your business, right? That way you can do a receipt,
You
have
can.
that kind of thing. That way it's documented that it transitioned from your ownership to the business and what the value was estimated at the time.
You can, or you can do what, you know, just think about if you have a rental house or a house, and you take that house and you convert it into a rental house. What value do we use? We use the value that was paid for it originally. So what would be good is if you did have, you know, you had a sofa and you happen to have the receipt, or, you know, what you paid for it, realizing there's some use that, what would be the worth of it at the time you put it into use. And that's what I would use. Any other questions? Those are all good questions.
I found it interesting. You said because they didn't do a background check and the IRS felt like they didn't do their due diligence.
I know.
Yet the government makes it harder and harder. Like, didn't they just pass the law that liens and judgments don't go on credit?
I know. So
I just ran into that, went under contract on a property, and the credit score was good and there was nothing, but then once title work came through, there was all these liens and judgments that popped up.
yeah. It's an interesting case because, and I'll give you the reference again, but when I read it, I thought, are you kidding me? So, I mean, it really was unfortunate for the couple. They just got screwed too many ways on that one. So, home office, do any of you use your home for conducting business? Okay, so, and do you know there's two different ways in which you can determine what the value is of the home office? Is anybody aware of that?
Take the percentage.
Check how many rooms you got and divide it.
That's one way, that's actual. And then we've got the simplified. So I like to talk about the simplified. A lot of people don't know about that. It doesn't create any recapture issues with depreciation. You don't take depreciation. It doesn't require that you keep all of your utility receipts. And it's simplified because it's truly that. It's $5 a square foot up to 300 square feet. So if you have an office that's 100 square feet, you're going to get a $500 deduction. It doesn't affect your mortgage interest on that you can deduct on your Schedule A. You don't have to worry about splitting that and taking part of it on your business or your rental, or part of it on your Schedule A. You get to still take everything on your Schedule A. You get to take all of the interest from your home. You get to take all the tax from your home. The only difference is now we get to take that additional simplified home office, and it goes in the same place that the home office for actual expense. Saves time. A lot of times, I'll run it both ways for my clients just to make sure we're taking what's most advantageous. But I find more times than not, unless they have a really large home office, that the simplified method gives them a better bang for their buck because we're not taking away from their Schedule A.
You said there's no recapture tax?
There isn't.
Is that
So-
$500, did you say?
No, it's $5 per square foot up to a total of 300 square feet. So the maximum deduction under the simplified is $1,500. I was just using 100 square feet as an example.
And that number is not an audited number?
It's not, and that's what I really like about it. So I really, now of course, you bring up a great point.
It's the other way it is.
It is, and I love that you brought that up for me. You still have to have regular and exclusive use. I mean, it still follows the same rules. You can't have, bedroom right next to your desk. It's supposed to be regular and exclusive use, but it's not an audited item. Hopefully that's a great tip that you can all use.
Yeah, it's another $1,500 I can write off.
There you go. There you go. So another expense you can write off, legal and professional services. I know we have some attorneys out there, at least John, and when my clients come to see me, if we're filing everything on their 1040, we'll take a large portion. We'll be very generous in what we take from our tax prep fees to allocate to our rental and or business if we're doing a Schedule C for fix and flip. So don't
Just so you know, I won't be generous. You'll be generous, but I won't be.
So don't forget about that. And then, property management companies. If any of you are is anybody using a property management company to manage your properties? Okay, those are deductible as well. So I hope you're taking those. They send you those nice statements every month, and at the end of the year, they give you a summary. We're always looking for that when we get a 1099 from a property management company. Okay, so now we're hitting one of my favorite expenses, and I say that not in jest. And that's depreciation. And when I say I see a missed expense, this is another area that I think if people don't understand it, they just figure, oh, I'm going to not take it, that it won't hurt me. So what is depreciation? Depreciation is when we take an asset that has a life that's greater than a year, and we spread it over the life, or we spread it over its actual life. Houses, rental that are non-commercial real estate is spread over 27.5 years. Commercial real estate is over 39 years. Now, one of the things that you need to understand as well, we can only depreciate the building itself, not the land it is on. And that's another item I typically see is either they depreciate the whole amount and don't take into consideration that there's a value to that land, or they don't take any depreciation at all. A good rule of thumb of how to figure out what the land is worth when you buy a house is to look at the public records, the assessor's records. They give a breakdown of what they allocate. I'm not saying use that dollar amount, but use the allocation. They have an allocation to land and an allocation to building. Use that percentage to help you determine what is allocated to land versus the actual building itself. Are any of you utilizing the small taxpayer safe harbor election for building property? Do you even know what I'm saying when I say that? Any of you aware of that? Okay, so 2 years ago we had some major changes to the depreciation schedules and how they operated. And one of them was very favorable to taxpayers, in particular those who held real estate. And the way this particular depreciation works is that you can make an election, and I'm going to show you how to make that election here on my slides here in a minute. So just listen, and then you can write it down here in a minute. What it allows us to do is to elect to say, I'm taking this property, and I'm going to, if I have some repairs, let's say, or actually not repairs, I have something I would have capitalized. It would have been an improvement. I would have improved a bathroom. I would have improved a kitchen, whatever it is. If that amount of the improvement is less than 2% of the total unadjusted basis, and I know I'm talking a lot of big terms here, and we'll break it down in a minute, but if it's 2% or less of the unadjusted basis, I can elect to expense versus capitalize. And so this is one of the great things for a lot of my clients that hold properties. So things that we might have had to capitalize in the past, they have a house that's $200,000, let's just for simplicity, 200,000 times 2%, that's $4,000. Something that we might have capitalized before, we can now just expense in that tax year. So it has been a great benefit to a lot of my real estate savvy individuals. So
You lost me.
okay, so let's break it
If you own
down.
free and clear property, you don't have anything, you don't have any basis.
So unadjusted basis. So if let's say we have a house and its value is $200,000.
Okay.
Maybe we fully depreciated it,
Okay.
but we're looking at the unadjusted balance, meaning before depreciation.
Okay, your original basis is what you're saying.
Your original basis.
Okay, that's, okay.
So it does not take into consideration what you've depreciated for purposes of making that calculation, whether you can expense or capitalize.
Do you have to elect that and keep that property in there, or?
You do elect it, and I'm going to show you how to do that in a minute, but that election is something that you put in a statement on your tax return that says, I am doing this.
Is this on top of your other expenses?
It is. Any other questions? There's some rules specific to it. For example, the house cannot be, or the real estate property cannot exceed $1 million. If it does, $1 million is your cap, or $10,000 is what you can expense. So think of it that way. So there are some rules to it, but overall, it's one of the most beneficial changes that happened in the last 2 years. And I'm going to go through how to show that here in a second. So now, along with that, repairs. So I said, depreciation is taking an asset. An asset is something that holds value for more than the current year. Repairs is something that takes care of putting your property back into the condition it was. It doesn't elongate it. It allows it to continue to operate. I think most of us understand that. A lot of times we have a lot of case law to, in regards to roofs, in particular for real estate, but not talking about roofs, but in general, repairs are just putting the property back into the condition it was. So we have another one of these safe harbor elections that came about. And there's a notice called 2015-82, which basically allows us as taxpayers to expense, not capitalize, expenditures that either the invoice is $2,500 or less, or each individual item on the invoice is $2,500 or less. So let me break that down. And this is not talking about the building itself. This is talking about, let's say you have an apartment building. Let's say you decide you're going to replace all of the stoves in the apartment building. And you have I'm going to do easy math. Let's say you have 10 units. You have 10 units, and each one of those stoves is $500 each. That's $5,000, correct? So if in the past, we would have capitalized that and had to run it over 7 years. Now, we can, with this election, even though the amount exceeds the $2,500 per item, it's $500. We can actually expense that all in the year that we put those items into play. So that is one of my favorite, yes.
So you could do the same with water heaters that are $2,300 a pop.
You can.
Furnaces?
Most furnaces are going to exceed the $2,500, but I found very few that fall below that.
Break it out by the item versus the labor?
No, you can't. That's one thing you can't do. So, but I want you to think about these things when I say this. So it's got a two-edged sword. So it's great we can take that expense right then. But let's say you've got this apartment building and you want to show a prospective buyer, you know, this great asset, and hey, I did these things to it. If you're expecting those stoves to show up on your balance sheet, they're not going to. You can show them the receipt, and that should suffice, but you're not going to have these items sitting on your balance sheet. Does that make sense? Because we've expensed them. We took advantage of that in the year. So if you have to provide financial statements to a third party, that would be a time like a lender or something like that. They might be looking for these things. You're just going to have to explain what you did. You know, I took advantage of the tax law that allowed me to do X, Y, and Z. Be consistent with your policy. Now, this is a year-by-year election, so this is something you elect every year on your tax return. But with that, you can't say, oh, hey, I'm going to expense this item that's $1,000, but this one that's $1,500, if my policy says I'm going to expense anything $2,500 or less, you can't pick and choose. It's whatever that policy is that you put in place. Now, as a small taxpayer, and that's anybody under $10 million, you don't have to have a written policy, but I will say that it's good if you do, and just have it in whether you have an entity where you have meeting minutes that you take, or just what I call a permanent file. I would just have something that said, my capitalization policy is, whether it's 1,000 or 1,500 or 2,500, state what it is so that you use that. Like I said, the de minimis limit, and again, I mentioned de minimis earlier, but they consider this de minimis. It's per item or per invoice, so your choice. Here are these elections. So the first one is for the building. And this is just a statement that gets attached to your tax return. And if you're doing your own or you're doing TurboTax, there is a way to attach a statement. I think they call them, it's an unscheduled statement, and you can do that yourself. And so, but this is the information that's required. And then if you're actually taking the election, and again, let me back up. This is done on a building. So if you've got 5 rental houses, you're going to have 5 of these statements for all 5. And then the election for the de minimis safe harbor is just as it is. You don't have to list out, oh, I bought 10 stoves. You just say, I'm electing to use the de minimis safe harbor. Okay?
And when you get audited, you just show the receipts
Yes. Yeah.
for that.
Right. So, time for a joke. The rainbow was on your property, Mr. O'Toole, so technically you are responsible for claiming the gold as personal income. So what are some great guidelines for, and these aren't all inclusive, but what would be great guidelines for real estate accounting or just business in general accounting? Well, the first one, and I hit this when we were talking about the casualty loss, and that's to document, document, document. You can't over-document. I have one client that comes to see me every year, and he has 2 rental properties, and he brings in his nice binder. He doesn't use any software to do anything, but he has everything organized by category. He has them all in little slip things, and if I want to see something, he pulls it out and he shows it to me. And what I appreciate about that, even though I don't need that kind of level of detail, he knows where everything is. And so I can't overemphasize how important it is, because you don't know when you need the documentation until you need it. And then it's too late usually. And keep your records organized. You know, that's another great thing. I mean, try and organize them. Some people, I don't care if they're organized by month or by, I suggest you organize if you have several properties by property or by category, or you can do it by month. But, you know, pick a system and stay with it. Don't change systems every month. So use a system for tracking your expenses. For some people, they use an Excel spreadsheet. As you grow your business, whether it's fix and flip or buy and hold, as you have more and more properties, it's harder to track those expenses using a spreadsheet, because inevitably what happens is something gets missed. And those are the expenses that you never get to take because you forgot about them. Oh, yes?
What software would you like to see your clients use?
Honestly, I really don't care. I have clients that use Xero. So that's a similar product to QuickBooks. I have clients that use QuickBooks. I have clients that use FreshBooks. It's really what they're comfortable with. I prefer what we call two-sided, double entry accounting that allows you to have a balance sheet, especially since you're going to have assets. So a product like Quicken only really shows your expenses or money, Quicken or money. They only show the one side. They don't show, per se, the assets you hold. But I have some clients who use that as well.
But if you're using a property management company, they've pretty well got most of those expenses for you.
Absolutely.
And
So
they are using the software.
Sure, absolutely, Calvin. So in that instance, what would you be tracking? The things that maybe, you know, you had to, maybe you went by and, you know, had to fix the doorbell, or you had to do, and you're doing nothing. So if you're doing absolutely nothing and you're not driving by and you're not doing anything at all, then you're set. You really are.
People own properties out of state.
Pardon?
A lot of people own apartment buildings out of state.
They do, absolutely. But they still typically have travel. They might go out there. Sometimes they have partners. They're part of a partnership, so they have expenses that they don't run through the partnership that we do deduct. So there are some other expenses like that. So, you know, consider those things as well. But if you're not actively managing yourself, I mean, you've cut your tracking in half by far, you know, easily. Treat your real estate like a business. I can't overemphasize that. I mean, it's one of the best assets for, you know, wealth generation. But if you don't treat it with the value that it has, you're not going to, per se, appreciate and take all the deductions and get all that you can out of it. So really treat it like a business. If you need to set up entities, and I'm not going to talk about that today, but there's definitely benefits when we talk about liability and different things like that I'm sure John would love to talk to you about. Here's one that a lot of times when people start out they don't do. And even if you don't set up a separate entity, set up a separate checking account. Again, there are expenses that you lose because you're running, I'll call it commingling, and you're putting everything through one checking account. When I started, we started out with a rental property, which happened when my husband and I got married. We both had a house, so we ended up being landlords. So we set up a separate checking account. It was just another personal account, but that way we ran everything through there, and it made it easy for us to track our expenses. And of course, find a great CPA.
How do you do that?
and build a team. And so when not just the CPA, but build a team. Build a team of lenders that you work with. Your lender, if you're using a real estate broker, an attorney, a financial advisor. Those are all great people to have on your team in terms of people that want to help you do what you want to do. Okay? So in case you would like to come see us, we are located just right around the corner here at 5527 North Union, right across from East Library. There's the outside of our office as you look in. And here's some of our staff. It's not all of our staff. We actually have 10 people at our office. But we are here to help your business succeed, no matter what that business is and what you want to do. If you would like a copy of this PowerPoint because you didn't get a chance to write down those elections and you'd like that, feel free to email us. You will need to write that down. but Hillary will be happy to send you a copy, and she'll just send it off to you. So it's admin@wilklowassociates.com. We have, if you're interested, we do offer half-hour free consultations. I failed to recognize that Eric Verkler, who's another CPA in our office, is here with me tonight. And so he is happy to meet with you as well as answer any questions. I have several of you out there that are clients of mine. I'm excited that you're here, and I appreciate you coming out to support. Thank you very much.
All right.